Our tax team hears this constantly in one of two versions. Either I paid my estimated tax payments each quarter on time, so why do I still owe the IRS every April? Or estimated taxes, I haven't been paying those at all. If either one of those is you, this episode is for you. I'm Danielle Hayden, CPA, former corporate CFO, and founder of Kickstart Accounting Group. You're listening to CEO Numbers Network. Quick disclaimer here. This is for general education and not personalized tax advice. Talk to your own CPA about your specific numbers. Today, I'm explaining a term that most business owners have never heard of, safe harbor. I wanted to talk about what it protects you from, what it doesn't do, and how to close the gap either way. Let's talk about both of those groups of people for a second, because I don't want any one of you tuning out because you think this episode isn't for you. If you've been paying your estimated tax payments every quarter on time and you've still gotten a surprise bill, I want to be clear, that's a real problem and it's very, very common. And we're going to explain exactly why it happens. If you haven't been paying estimated taxes at all, I want to say this clearly, you are not in trouble. Right? There is no shame around here. I'm not here to lecture you. In my experience, most business owners in this position, you're really not trying to avoid anything. It's just that nobody sat down and helped explain what is required. And because it feels too uncertain to commit to, I understand. It just keeps on sliding to the bottom of your list. Trust me, I understand that there's so many things for you to do as a CEO, and making your estimated tax payments is not the most exciting thing. So if that's you, today is a completely fine day to start. So here's the thing that both groups of people have in common. Neither one actually knows the difference between what the IRS requires you to pay and what you should actually have saved. Once you understand the difference, you'll know exactly what to do next, whether that's fixing the gap you've had for years or building the financial habit for the first time. So let's start with what safe harbor actually means. The safe harbor is the IRS's rule for how much you have to pay throughout this year so that you don't get hit with underpayment penalty. That's it. That's all you're doing. This is a penalty shield. It was never designed to tell you what your tax bill was actually going to do. Here's how it works in plain terms. You're considered safe if you pay in one of two amounts, whichever is lower. 90% of what you're going to owe for this year, or 100% of what you owed last year. And if your income was higher, over $150,000, that bumps up to 110% of last year. Most CPAs, they default to the second option because it's the one you can actually calculate in January. Nobody knows what this year's profit is going to be in January. Everybody knows what last year's was. So your CPA hands you a number based on last year, and you pay it in 4 quarterly chunks. And as far as the IRS is concerned, you are safe. Your CPA will give you these amounts as part of your tax return as your air quote coupon amounts to be paid each quarter. Those coupon amounts are based on last year's income. Now, if you're in the group that hasn't been paying anything at all, this is your starting point. This number, the safe harbor, it's the floor. It's really not optional if you want to not pay any penalties and interest to the IRS. Now, get this number from your CPA and get on the payment schedule. That's step one. No matter what else you take from today's episode, you can take that very clean and clear action. You'll get your previous year return from your CPA. You will get that payment schedule from them. You can go right onto the IRS website right now and schedule out those payments for each quarter today. For everyone already doing this, it's good advice and it's accurate, but I want to be clear, it's the floor and it's not the entire tax plan. It is built entirely on last year's results. Here's my hot take. Business owners don't have a tax paying problem. They have a growing faster than their tax plan problem. You guys, this is a good thing. And I love when our clients are growing, and that means their net income is growing and their tax bill, in fact, is growing with them. I know it's a double-edged sword, but congratulations on your growth. If this year is better than last year, Safe Harbor lets you legally underpay all year and true up the difference in April. You are protecting yourself from a penalty, and you're making a down payment on what you're actually going to owe in taxes. That's it, a down payment. You know, it's like when you buy a house, you're making a down payment, but you still have payments to make throughout the life of your loan. It's the same thing here. Here's the mistake for both groups: believing that the floor was ever supposed to tell you what to save for your taxes. Those were never the same question. I want to tell you about two business owners that our team has worked with, because these stories cover just about everyone who's listening right now. The first client had been paying Safe Harbor faithfully for years. However, this time it was a great year. She landed 2 big new clients, she had raised her prices, and had her best year yet. She had paid every single quarterly payment on time, and she felt so confident walking into tax season. The 2 big clients that had come in for this year had paid in November. It was late in the year, late in the season, so all of her estimated tax payments had already been paid. Then she sat down with our team in April, and on top of everything that she already paid, she owed another several $1,000s. And her first reaction was, why is this happening? I did everything right. And she had, for the questions she was asking. She just hadn't been asking the question that mattered. Given how much better this year was going, how much should she actually be setting aside? Now, to be clear, this was a new client for us. She had just came to us in January, so she did not have her full picture in place. She had just gotten her bookkeeping complete. She had just started looking at her numbers every single month. She was not avoiding it anymore. Our second business owner had never paid a dime of estimated tax payments before she started working with our team. And she wasn't avoiding anything. She just genuinely didn't know what was required, and she didn't have bookkeeping in place. When our team walked her through it, we didn't just get her caught up on Safe Harbor. We started her on both things at the same time: the required quarterly payments and then a monthly tax reserve based on her actual current year-to-date numbers. These are different starting points, but they're the same fix. The first owner had a reserve on top of what she was already doing. The second owner built both habits from day one. And neither one of them, since they have implemented this strategy, have had a surprise since. At Kickstart, we call it the tax reserve. And here's the one sentence I want you to remember. Safe Harbor is based on last year's numbers. The tax reserve is based on this year's net income. Every single one of our clients at Kickstart Accounting Bookkeeping receives accurate financial statements at the end of each month through what we call the snapshot. In the snapshot, we include for you the tax reserve number. The reserve is roughly 25% of your year-to-date net income. This year's net income, not last year. This is reviewed every single month as the number actually moves throughout the year. You have to have accurate bookkeeping in order to calculate this number. So I want to be very clear. Do not just go and pull your net income amount if your bookkeeping is not correct. You cannot calculate 25% of a number you don't know yet, or that is based off of inaccurate financials. I'm going to place a link in the show notes for our Check Your Books service. If you are not sure if your books are accurate or not, go click the link for Check Your Books in the show notes, where we will do a review process of your bookkeeping so that you know if you're using the correct net income amount. Once you know that your bookkeeping is correct, once you know that your net income is accurate, then you can calculate 25% of this year's net income. Now, to be clear, the Safe Harbor payments still go out on the schedule your CPA gives you. That doesn't change and shouldn't. If you are just starting out, you're building both of these habits at the same time, not one after the other. The reserve is what closes the gap between last year's estimates and this year's real number, so that it's already funded instead of the money spent throughout the year. So you are doing both habits. You are going to use the amount from your CPA in your tax return from last year. You are going to pay the estimated tax payments based on last year's Safe Harbor numbers from your CPA in your tax return. Then you're going to pull your monthly snapshot with accurate, up-to-date bookkeeping to pull out 25% of the year-to-date net income. Take the 25% net income, your tax reserve, minus what you've already paid to the IRS. That is the amount that you need to have in a savings account. If you're a longtime listener, you know I want 3 checking accounts. One operating account, money comes in, money comes out. The second savings account is our tax savings account. And the third is our 3-month rainy day fund with 3 months worth of your average operating expenses. So use account number 2 to move your tax reserve dollars into a separate savings account so that you are ready for April. I want every tax season to feel like a non-event. It is just another Tuesday. We are ready for tax season. This is where your leadership comes in place. I don't want this to feel like a math lesson. The business owners who get blindsided in April, whether they've been paying for years or never started, they're not bad at math. They're reacting to a number instead of managing and leading with your financials. And there's a standard I want to come back to again and again on the show because it applies to almost every financial decision you'll make as a CEO. What happened? Why did it happen? And what are you, the CEO, going to do about it? What happened? Your profit changed. Your business grew. It's time to celebrate. Or maybe you're finally seeing your numbers clearly and accurate for the first time in your business. Why did that happen? Growth, more attention on the numbers, clarity for you as a CEO. What are you going to do about it? That's the part most business owners skip. They let the IRS answer that question for them. And in April, with a reactionary tax bill, a CEO doesn't wait for the invoice to find out what something costs. And a CEO doesn't wait until everything feels figured out to start managing it. You start with what you know today. So here's what I want you to actually do with this. And again, run all of this by your own CPA. This is a framework, not a substitution for that conversation. Step 1, if you haven't been paying estimated taxes at all, talk to your CPA, get your prior year tax return, get your safe harbor numbers on that payment schedule. Step 2, open a separate savings account used for nothing except for taxes. If that money is sitting in your operating account, I promise you, if you're anything like me, it will start to feel like it's available to spend. And eventually it will get spent. Step 3, make sure your bookkeeping is current, not just accurate at year end. You need this year's real net income monthly to calculate a real reserve, not a guess. Your bookkeeping has to be current and it has to be accurate every single month in order for you to own your role as CEO, to go through these answers and to take action. Every time you notice this year's profit is running ahead of last year's, treat that as your signal, your CEO signal to revisit your reserve, not just your safe harbor payment, which won't move until next year's return. If you are an S-Corp owner, make sure your reasonable compensation gets reviewed throughout the year because it affects your net income and your tax reserve. They are connected, so treat them that way. So let's go back to where we started. Maybe your version of the problem is, I did everything right and I still got a surprise. Or maybe it's, I haven't started doing this at all. Either way, the fix here is exactly the same. Safe harbor payments, they keep you compliant. The tax reserve keeps you prepared. And both of those start today, right now, as a CEO of your business. If you want help figuring out where your numbers actually stand, that is exactly what our team does here at Kickstart Accounting Group. Our bookkeeping team prepares accurate financial statements delivered to your inbox with a tax reserve every single month. Our tax team at KSA Tax Partners, they come in and walk you through the mid-year tax check-in. They are going to compare where you are at year to date to what you've already paid and where you're projected to be at the end of the year. I want to invite you to work with the Kickstart Accounting team. Go book a call at kickstartaccountinginc.com. Our bookkeeping team would love to help you get your books cleaned up and ready so that you know exactly how much you're going to need to have ready for this year. Our KSA Tax Partners team is ready to help you understand these numbers and stop treating April like a surprise. If you'd enjoyed today's episode, go like and subscribe. We have so many episodes that are coming out to help you keep leading like the CEO that you are.